I think the biggest failure and the problem with market cycles that investors run into is the failure to recognize a market, and or B, they forget to expect that the market at some point that cycle is going to end. All cycles do end, and it's if you stand too long, it's like Vegas. The house always ends up winning. So you have to be able to see it coming, know when and why it's coming, and certainly know when the right time is to get out, to be that smart money, and to your point, not follow the masses. So let's start with the accumulation phase. If you could kind of define to me what that means as a professional investor in your world. What are you doing during the accumulation phase, and what are pros versus I would say amateur investors typically doing within that market phase?
Yeah, I'm going to break this down quickly. Within a market cycle, you have an economic cycle. So that's very important. So let's zoom quickly out. You have an economic cycle. There's usually four phases, right? You've got the expansion phase, you've got the peak, then you have a contraction, and then you have a recovery. There's different strategies during those time. And a same kind of thing, very cyclical, where you have these almost decade-long economic kind of cycles. And just to share kind of where I think I'm at is, we've had a very good run over the past decade in the economic cycle. So we probably peaked out at the end of 2022. That was your peak. That's when you had the interest rate spikes and the economy was then declining. We had the liquidity declining and, of course, the interest rates going up into a weakening economy. So you're going towards, from the peak, moving slowly into a contraction phase. But if you look at a market cycle, here's what I would share with folks. There's this great chart called the Wall Street cheat sheet psychology of a market cycle. Now, why would I share the Wall Street cheat sheet if I am a person that's not in the Wall Street world and I am all in on alternative assets? Well, every market has market participants, and they're humans. They're us. And we humans are strange creatures. So we are driven by psychology. So market participants, again, move and drive a market. And it's the psychology part of it, which is massive. And of course, people would say, well, MC, the average investor doesn't move the market, especially Wall Street. It's more institutions. Well, there's fund managers in those institutions, and they're run by humans. And it's even worse because their incentives is to react and overreact and make moves quickly because they have bonuses and compensation depending on it. So it's even, and this is very, very short term. So it's even worse than the average person that will put money in, let's just say, a Wall Street account and just let it sit there for decades, right? So when you look at the market psychology, I think it's a great kind of map to look at a market cycle. So the first thing is right at the bottom, which you mentioned, accumulation phase. This is depression. So I'm going to start right at the bottom. Depression is the point of maximum pain for everybody. This is everybody's depressed. This is in 2001 during the dot-com crash. You heard stuff like tech is dead. It'll never come back. Google and Amazon didn't get the memo, right? But that was the psychology during this time. We just got destroyed. Dogs.com and cats.com and pets.com, all these companies just got crushed. Blood in the streets, maximum point of pain. Real estate. I remember, I'm old enough to remember this. You'll probably smile when I share this. I'm old enough to remember when they stated in 2010, the media, meaning they, that real estate's never coming back, ever. Real estate will never, ever be a vehicle to grow your wealth and exponentially or warehouse wealth in, right? Yeah. This is all over the media. You can look it up. It's comic relief right now, but that was depression. This is the accumulation phase. This is when the pros come in. When everybody is fearful, that's the time to be greedy, as Warren Buffett would say. So this is where the pros get in. And, if we look at the lost market cycle, we had events happening in the beginning of March of 2008. That's where Bear Stearns went down. Then we had October 2008. That's your Lehman moment. And then we had a massive, massive crash and pullback. By 2012, end of 2011, 2012, that was the bottom. That was depression. And that's where most folks came in. Then because the professional money comes in and big time, there's an uptick. And all of a sudden, there's a little spike in the asset class, right? And people say, oh, whoa, what's going on here? Something's happening. Still a little bit of disbelief. Then there's more hope coming in. And as there's more hope, there's other early movers that move in. The pros are already in, remember, but only other early movers are coming in. And all of a sudden, there's a point of optimism in a specific asset class. And now people are coming in. And this drives the value of the asset class collectively even up further. And now there's belief. And this is the time usually when the majority of the public piles into an asset class. And then it leads to the next part, which comes to like thrill. This is the point where people get very irresponsible. Because, oh, this thing's going up. Everybody's going to be rich. We're going to make so much money. We're going to have, this is the point where you had folks that would, under normal circumstances, not qualify for a mortgage. They had 3 or 4 or 5 of them because the price keep going up of real estate. They kept refinancing and keep buying more properties. In the last crypto cycle, this is where you had platforms like BlockFi and Celsius, where people were buying Bitcoin on them, placing it as collateral to borrow against, and buying more of the crypto. Well, this is very irresponsible behavior. This is where things are happening. And just a short note too, before this stage of irresponsible behavior, the pros are usually out. They're out. This is the time where they have switched from accumulation and being very aggressive to move towards capital preservation. So as the general public piles in and becomes very irresponsible, the pros have taken their chips off the table. They're protecting that now. So it's a different phase of the market cycle. At one stage, they were overly aggressive, deploying as much capital as they can, lending money through private lending, lenders, any way you could get hold of capital to acquire more assets. That was the time. Now, complete opposite. Now is the time to protect, right? Capital preservation and protect, because what comes next is quite remarkable. You get euphoria. All that irresponsible behavior leads to euphoria. It goes up even more. And most people would say, well, the pros are already out. Why didn't they stay and participate some more on that upside? Nobody can time a market. No one. I mean, if they tell you can time a market, run away. But they can see what's coming because they understand these market cycles. And then what happens is the first shoe drops after this huge euphoric moment in the market. The first shoe meaning an event. An event happens for that first drop. It could be the Bear Stearns moment. Boom, market pulls back a little bit. Doesn't completely crash. That was March of 2008, March or April. It's right about there. First one drops, and all of a sudden, everybody that came in late, they're now in the red. They're in a losing position. So they stay in, right? They stay in and they say, okay, this has to come back because we got to make money. We've lost money now. And it goes sideways a little bit again. And then your next moment comes, your second big moment. And in the 2008, 2009, that was your Lehman Brothers moment. That was October of 2008. Boom. And that's when it went all the way down. So it went from a complacency in the marketplace to anxiety, denial, panic, the capitulation, the mass sell-off, and it's a bloodbath. And it now people are angry and it goes back to depression. So it's a full market cycle. There's different strategies at every single different part in this market cycle.
Yeah, 100%. And just to kind of summarize some of that, and phenomenal information, obviously spot on. So in that first phase, we can call it the accumulation phase. That's when basically it bottoms out. If we're using real estate as the analogy back in 2008, and to your point, by 2010, it really stopped falling. So but people were terrified. So while smart money, was super bullish on the housing market, most of the majority was obviously very bearish on it, and that led to a parabolic about Climax, and you and I have talked about that before, which is effectively a reverse market trend, which is what smart money is doing, in those instances. And then you go into the markup phase, which is kind of the worst is over. You get kind of those fear of missing out investors, valuations climb. It's, kind of have that greater fool theory comes into play at that point, and smart money starts to unload, while the vast majority and the late majority really starts to buy into it at that point. Smart money's gone, or leaving, quickly at that point, because, to your point, it's impossible to predict an exact end to a market cycle. It's going to end, so it's kind of, you cut out when you're well ahead and you move on to the next deal. As a, smart money investor, you don't feel the need to hit a grand slam every single time. I always say, people are in the Baseball Hall of Fame that only hit singles and doubles, right? It doesn't have to be a home run, doesn't have to be a grand slam, but you protect your earnings to avoid those losses. So then you get into the distribution phase, which is what you said. It's fear, it's super emotional, it's seller dominant. A lot of people then are moving out of their positions at small profits or even losses just to kind of wash their hands of it. And then you get to the final stage of the markdown phase, and at that point, it's the most painful. People that are still holding a position, to your point, are upside down at that point. And again, due to the cyclical nature of that, that's the blood in the streets. So smart investors are then perking up because they can come in and buy those distressed investments and wait for the markup phase again, right? And it starts all over.
And what's interesting about this? If we get 1,000 investors and we give them all $1 million, every single one of them, and we all invest during a market cycle, at the end of it, the money is going to end up with the professional investors. It's just that's a wealth transfer through these cycles. They do, and money is never money. There's no money heaven. There's no capital heaven. It doesn't disappear. It changes hands, and the professional investors that know these market cycles stay very unemotional. They just know this is the game. They enjoy every single aspect of it just as much as they enjoy the massive sale, right at the bottom where they accumulate and they come in. They enjoy getting out just before the top and then just sit back, maybe with some scotch and a cigar, looking at the chaos unfolding for the rest of it, protecting their capital, waiting for the markets to come down, because they know then they'll again be able to buy assets at record discounts. One market, and every market's got different cycles too, right? And they could be at different stages or different phases in every market cycle. So I just wanted to state that. And the other question that I get a lot from people is, well, how long are these? It all depends too. We had the dot-com bust in 2000, and from 2001 to 2008, we had a very, very good run. And then all of a sudden, the downward trend was, if you think about it, really 2009, 10, 11, 12. So you almost had like three and a half, 4 years. Before people can scoop up. And this one has been quite a run. This one, a lot of professional investors even started to taking some chips off the table in 2019. But then you had another event, a black swan event in 2020, where all this capital was being generated and created, which changed the dynamic. So history doesn't necessarily repeat itself, but it sure does rhyme, as Mark Twain would say. So that's important. And I just want to share, this insight, because it's comical when you think about it now. So in my world, there's a lot of crypto investors, and this is like a spectacular market to watch market psychology play out. So the first crypto cycle that I went through in 2017, I remember when these platforms like Coinbase, before they became a public company listed on the New York Stock Exchange, where you could buy crypto, sent out an email saying, we are seeing a lot of irresponsible behavior, basically, and their platform was almost shut. They couldn't handle all of the volume of the majority of people just piling into crypto. That was your euphoric moment, if you've ever seen one. And most people, if they weren't already out that then, they sold everything. I know guys and gals that sold everything when they got that email. They're like, that's it. We're out. Everybody else is coming in. This is going to end badly. And it's, of course, very violent, the crypto market. And then the next cycle was even more crazier. You remember the crypto Super Bowl? This is kind of comical if you think about it now. So you had the crypto Super Bowl, and I mean, like, if that is this should be like a case study of euphoria, because you literally had Matt Damon calling out your manhood basically for not buying like crypto on national TV during the Super Bowl. Yes, and you had FTX had every other ad with remember those with Larry David from Seinfeld and Curb Your Enthusiasm. So you had this huge euphoria to the world. Every other ad was almost like a crypto ad, and I'm like, this is like incredible, because this, I mean, if this is not a top in euphoria, then I don't know anything about investing, and I should never be involved with this ever again. Everybody was, I mean, I spoke to folks around in our network. They sold everything. Yeah. When they saw what was going on in the TV, people started selling crypto. Yeah. And even like the following day, and of course, we all knew what happened, violent collapse of all of these over-leveraged platforms like Celsius and BlockFi and so forth. So, I just wanted to share that too, because there's some, even if you don't want to go back, 23 years and, you're even a younger investor, you could chuckle just looking at the crypto cycles. They're shorter, they're every 4 years, and there's a lot of lessons that you can learn as an investor studying them too.
Yeah, a lot of people, and Matthew and I were talking offline the other day just about crypto in general. I think it's back up to what, 42K now, something like that in the 40s. So I mean, a lot of people just can't handle the volatility of it. A lot of people have continued to DCA dollar cost average it. I don't want to really go down the rabbit hole with that, but a lot of folks just don't have the appetite for it. I'll kind of leave it alone at this point, but the volatility of that has been nuts. I mean, especially recently. So let me just hit pause here real quick. So those of you that have seen MC on our channel before, and we'll go ahead and drop a couple links. One of the reasons that we really like to bring him on is he's got some phenomenal financial solutions to help really navigate through market cycles like this, avoiding Wall Street, which is something we often talk about with him, and doing your best to avoid the banks. So I'm going to go ahead and drop an email below for folks that have been interested in content that he's brought on, that have interest in the content today, and then we're going to kind of segue that into really what your specialty is, which is the infinite banking concept. So and whole life insurance. So based on our dialogue today and these market cycles, I'm assuming I can probably give the answer that that whole life insurance and the IBC is a perfect way to position yourself during times like this. Can you elaborate on that? And for those that want more information, please send an email out to ninja@vipfinancialeducation.com. Put Ninja in the subject line and be sure to include your first, your last name, and the best phone number to reach you in the body of the email, and someone from MCR's team will get back ASAP. Guys, we've had a lot of folks through the channel that have moved forward with MC and his team specifically for the whole life insurance policies and the IBC. So stay tuned if you guys are looking for ways to direct your own money, be your own bank, avoid the banks, avoid Wall Street. Definitely reach out to him. But to that point, MC, how does that help investors, whether they're seasoned pros or just getting into the investment game? How does that product help them navigate and really shore up some of those loose ends that they may have if they're just trying to go it alone, or do the Wall Street thing, or just put their money in a low yield savings or checking account?
Yeah, so where we are in the market cycle right now, my worldview and how I see it, now's the time for capital preservation and risk management. There's still some opportunities, short-term plays where you can move capital in and out, but the focus has shifted, right? So where we played a lot of offense aggressively and a little bit of defense, we're now playing way more defense than offense. There's still some offense, but it's defense. And in the end, just as in sports, because investing is a game too, a fun game, you have your offense that's going to win you games, but your defense is going to win you championships. And that's where infinite banking comes in. That's where life insurance comes in. If you think about capital preservation, which should be the priority, is protecting capital more than chasing massive gains. This is a fantastic vehicle, because where would you keep capital at this stage? There's a lot of uncertainty. There's a lot of stuff happening out in the world. I mean, we've just seen in 2023, we saw 7 banks go under. 10 placed on downgraded by ratings agencies. And usually when they do that, it's almost like the beginning of a crisis, right? 11 has been placed on watch lists. We're seeing massive layoffs in the banking sector. We're seeing the closure of branches of major banks all across the country. You pick your big banks, there's closures and there's layoffs. So when you're looking at to protect capital, you have to look at it holistically. So do I just keep my money in the bank? Well, the FDIC just told me that they can only cover 2% of the deposits. So they don't even have the money to cover all the deposits, which they currently insure. So, would you keep it in a bank? And obviously, as you can tell from me, I'm not a big fan of that. That wouldn't make me sleep sound at night. You still do need a bank account because you're running a business, so keep very limited in there, large amount of capital. Personally, I would think that is very, very risky at this time. The other thing is, your other options are bonds, which is like a triple threat, basically. Interest rates being the major threat of the bond, and obviously the other side of it is your counterparty risk. And then I've got people that are involved, some bond traders all over the world. Your currency risk is also a risk to exposure. And then you've got qualified plans, you've got IRAs, and so forth. All of those are extremely, at this particular point, in my worldview, risky, and there's a lot of risk involved with that. So what do? I try to copy. When I played sports, I try to copy of the best players, looking at what they're doing in the world of investing, in the world of business and money. I try to copy and see what are the wealthiest investors doing? What are the professionals doing? And they're all in cash, and a lot of them are warehousing their capital in mutual life insurance companies and insurance contracts, where it's a private contract between you and that mutual insurance company that's been around for 150 years plus. They've been profitable every single year during their existence. You have a guaranteed, your capital's guaranteed. There's guaranteed growth, tax-free, which taxes down the line, if we look at where we're at, what is it, $34 trillion in debt right now, just in the United States. So you're protecting that future tax exposure and liability. And then also you have guaranteed access to this. I got my teeth kicked in 2008 and 2009. I had HELOCs pulled. Again, I didn't know market cycle, so I came in and bought a bunch of real estate in 2009, caught a falling knife, made all the mistakes. So from that, I'm learning that, hey, this time, because, I could see where we're at. I want my capital. I want to protect it. I want it guaranteed growth, tax-free. I want guaranteed access to it, because when you're going to need capital, there might not be capital to access. So this strategy with infinite banking and warehousing it at the correct place is very, very powerful. And right now, and I could see I could see a lot of extremely wealthy investors doing exactly that. Family offices, we've seen everything in our world positioning themselves in these contracts to be able to capitalize on massive opportunities, because they're coming. And like I said, I'm a very optimistic person. I see a lot of opportunities in the coming years, and you want to be able to access capital when those opportunities reveal themselves.
No, 100%. And we talk often on our channel about real estate investing. And I would say probably 90% of our audience is involved or has some interest in getting involved in real estate. And we've been really successful with a platform that you're familiar with. I've talked about it on your podcast with the preferred lending. And by design, it's in the luxury space. That market is still booming. It's not affected the same way, kind of lower price points are, particularly in the flip space. So that's been an absolute boom. And people that have taken advantage of the infinite banking and have whole life insurance policies through you, are utilizing that as an instrument to get involved in these. People that have, hoarded cash, or they've, picked up, debt weapons like HELOCs, and they've got direct access to those right now, are killing it. They're getting involved in these projects anywhere from 50 to a couple $100,000 because they did the right things and they had access to that now so that they could capitalize on these deals. And they're seeing returns anywhere between 20 and 35, 40% in some cases within a 6-month period of time, cash on cash. You would double that, to do an annual cash on cash return. And it's collateralized by the real estate. So, you're short up there. They're in the single purpose LLC. So from an entity structuring standpoint, which I know you always preach, that is buttoned up as well. So there's opportunities out there right now if you're poised and you're positioned for it. The preferred method that we're doing with Maven is one, obviously, analogy or one example of that. And you're sharing some yourself, but it's all about doing the right thing so that when those opportunities do come along, you're in a position that you can capitalize on them. So we're in that phase right now. What do you think is coming next? Does it ever break the cycle and kind of skip one of those stages? What are you thinking is going to happen next? And what do you think the pros are going to do?
Yeah, and that's a great question because as you mentioned, we have another presidential election year next year. So it's very, very interesting because you look at this and people say, well, when do we see this banking crisis like really gaining steam? Because, for all of the listeners and viewers, banks are in trouble because of the interest rate spike because most banks had their money in bonds. That's where they would just keep it in bonds, right? Well, what happens if interest rates spike up is the value of bonds go down. And when interest rates double and more than double, you're sitting on a significant loss in your bond positions. Now, a lot of those banks they usually have like bonds that they hold to maturity and other bonds which it would sell if they need to produce capital to their depositors. Well, what happens if there's a bank run? Then you've got to sell all of those, and that's what happened to Silicon Valley Bank, right? So back to what do I see coming? You've got a presidential election year, which is usually you juice the markets, you lower interest rates, you keep it there because you don't want people going to the voting booth that's down significantly in their assets, the value of their assets, all depressed and demoralized, right? So with every cycle, you want to juice it. So this is going to be interesting. Could the next shoe drop next year? That could be. But if you look at the past, like usually presidential election years, they juice it. There's lowering of interest rates and so forth. But what I can say about also next year, if you look into 2024, what we are talking about too, and what I would recommend your viewers definitely look into is just become as mentally tough and strong as possible. Prepare for all kinds of crazy scenarios. Because I'm a political atheist. I don't believe in any of those things. I just see the world for what it is, and I could see a very polarizing country in the US. It's globally, by the way, every single country. You have very polarizing populations. So that will lead to like fireworks, especially when it comes to elections. So as an investor, you have to operate in all of this. So what we're looking at is saying, hey, it's going to be wild. It's going to be crazy. There's going to be a lot of emotions in the marketplace. Here's what you do as an investor. You keep a cool head. You focus what you want to grow, which is grow as an investor and your portfolio. And you keep your eye on the prize, like look at what's happening in the marketplace and capitalize into opportunities. Don't get emotionally sucked into any direction. That'll just take away from what you're trying to do and trying to accomplish. So that's what we're looking at. I'm looking at kind of a chaotic marketplace that you've got to operate in. So I'm mentally preparing for it to be as mentally as tough as possible. I'm keeping a cool head. I'm every single day writing down the stuff that's important to me that I need to focus on, and that's where my focus is going to stay. Focusing on all of this kind of stuff because I think in times of kind of chaos, and times of like a lot of wild cards happening, massive opportunities for folks that could stay calm, keep a cool head, be non-emotional, and focus what they want to grow. And I know viewers want to protect and build wealth for themselves and their families, and that's what we're focusing on.
Great answer there. And And I've said this on videos with you before when I was like, it's no time to get cute. Look, guys, there's a lot of money to be made and lost in the market right now. There is the opportunity to create generational wealth while everyone else, the majority, is doing the exact opposite because they're terrified. You know, that's when there's blood in the streets and there's opportunities to make money. If you know what you're doing, and the reason MC's got the ability to stay cool, calm, and collected, and why professional investors have that ability is because most of them have lost it all at one point, right? You've learned lessons the hardest way through the school of hard knocks. And, you know, once you've gotten your teeth kicked in a couple times, you know, you adjust and you get hardened, you get strengthened as an investor. So, you know, my word of advice to folks that, you know, are just starting on that journey, hook up with someone that has been through the market cycles a handful enough times. Don't necessarily just try and go it alone. You know, experts like MC, this is what they do. Literally, is kind of direct traffic for folks that not maybe don't necessarily know what they want to invest in or how to invest, but they've got capital to deploy, and they need folks to help them lead them down the right path. So if you are interested in hearing about you know, the right direction and, again, vehicles and instruments that allow you to do that, go ahead and email MC and his team at ninja@vipfinancialeducation.com. Put Ninja in the subject line, and be sure to include your first, your last name, and the best contact number to reach you in the body of the email. Someone from MC or his team will get back in touch with you ASAP, and at least have a consultation call. It doesn't cost a nickel, and you can at least get some guidance. You know, the ability to just gain knowledge and be a sponge in times like this, particularly if you're just getting going, is paramount to future successes. MC, love having you here on the channel. Appreciate you taking time out of your busy schedule. Would love to bring you on back here after the first of the year. Y'all, drop a thumbs up, a like if you want us to continue to bring MC back here on the channel. He's just an absolute wealth of knowledge. And if you're not a subscriber, go ahead and subscribe. Ding that bell for notifications as we continue to put these videos out. We enjoy doing it. Hopefully you guys are getting a lot of good little nuggets out of this. So that being said, everyone take care until we see you on the next video. Make it a great day. Talk soon. Thank you.